Hello guys and welcome again to my channel. So let's talk about the shareholders equity part 2. So again, the shareholders equity is just the capital for the corporations. Okay? So I have told you already that if we are going to compare it with sole proprietorship or partnership, proprietorship or partnership, we're just looking at the capital account, and that capital account will just be changed if ever there is an investment from the owner. And then the next one is we have profits or revenues if you wanted to. And then we have withdrawals, which could mean temporary drawings. Again, temporary drawings are just withdrawals of the owners based on their share of the net income. There is also permanent. Okay? And then that is to be deducted, as well as the loss. Aside from the loss, you can also use expenses. So those are the things that will affect the capital of the sole proprietorship and the partnership, basically. So they are easy, right? So in the case of corporations, I told you that whenever there is an investment from the owner in the corporations, it will be phrased as sold shares for money. So are they the same? Basically, the substance is the same. Because here, if you talk about investment from the owner, the cash will flow to the company. Our point of view is of the company, so the cash will flow to the company. And of course, the owner is the only owner, right? The ownership is his. If sole proprietorship, 100% ownership is his. Okay? So it's the same with this one because the corporation will sell shares. Selling the shares, and anyone who will receive such shares will become the owner or the shareholder. And then, in compensation for those shares, they have to pay cash. So it's very much the same with investment from owner because cash will still flow to the entity or the corporation. However, in the past episode, we have talked about this extensively. Here, the selling of shares or the issuance of shares. Why? Because it's not only money will be the compensation why you issue shares. So we have different types of context. Like for example, the number one is the issuance of shares for cash, which is the most normal compensation if you give shares to the shareholders. The second one, you issue shares also in order to get non-cash assets. Number three, you issue shares also if ever the corporation receives some services from a professional, like a lawyer or CPA lawyer. And number four, you can issue shares later on based on the subscription or promise to buy by the subscriber. That's situation four. And then situation five, we talk about subscribers still subscribing. So the subscriber in situation number four, there is no delinquency, but in situation number five, the subscriber became delinquent. So we have to look for the highest bidder, and we talked about the accounting if ever we're looking for the highest bidder and awarding to the highest bidder, right? And number six is you are still issuing shares from a subscription of a subscriber, and then the subscriber became delinquent, and after being delinquent, we tried to find the highest bidder, but we cannot find any. So we use treasury shares. So those are the six contexts, different situations where you issue shares. Okay? So actually, I was just referring to this one, investment from the owner or investment from the owner or in the corporation side, issuance of shares. I am expounding only that. Okay? So we're going to use this in order to go further in our discussion. So I'll start with the permanent withdrawals. Here in the corporations, that's treasury shares. So that's our first topic in this video, the accounting for treasury shares. Okay? And then, after the treasury shares, we might also add some principles that you need to understand and some other account titles that you need to know of so that we'll be able to complete the shareholders' equity and the list of accounts here. So far, we are at ordinary share capital, and second, if ordinary share capital, share premium, and we are already subscription receivable. We've already talked about this, and subscribe share capital. So far, so good. So those are the four account titles under shareholders equity. Now we're going to talk about treasury shares. So what is this treasury shares? So it's easy if we are going to illustrate, okay? Like for example, in our example last video, we talked about Mr. A. Mr. A getting 10,000 shares from us, right? Let's use that first example at 10 pesos each, at 10 each. Not necessarily 10 pesos each. For other countries to understand that at 10 each, it could be $10 each. With a par value, 5 each. So if this is Mr. A, what is the original transaction is that Mr. A has given BBG Corporation, that's us, that's that's our point of view. So 10,000 times 10 is 100,000. Okay? Mr. A has given that to our corporation. We gave Mr. A 10,000 shares with a par value of 5 pesos. So the original entry should have been debit cash. No, not on Mr. A side. We have debit cash, 100,000, and then credit ordinary share capital. However, it's limited to par value, so we have 50,000. And then the other one is OSC, share premium, 50,000. So that is the original issuance entry. Alright? Where does treasury share come? Come to the picture. So the treasury share will happen if ever this will be reversed. For example, this is the example. Mr. A wanted his money back. So he sold 10,000 of his shares, all of the shares, to Baby G Corporation back. And Baby G Corporation purchased it. Okay? So what will happen is that Mr. A will give the shares, 10,000 shares, and then Baby G Corporation will give Mr. A some money. Like for example, Mr. A sold that for a cost of 150,000 cash. So is it possible that it's like that? Yes, it's possible that it will happen like that. Like the only cash that we have received originally is 100,000, but we have to pay 150,000 to A in order to get the 10,000 shares. It's really possible. Okay? So as you can see, you'll be able to understand why I equated it with permanent withdrawals here in the sole proprietorship or partnership. It is because when there is a withdrawal from the owner, we pay cash. Also here, we paid cash. When we got back the 10,000 shares, we paid 150,000 cash. Okay? So that is a permanent withdrawal by the owner A. the treasury shares. So that 10,000 that we got back from Mr. A are considered as the treasury shares. Okay? What's the other difference? The other difference between these permanent withdrawals in sole proprietorship and partnership is that even if there are no profits or the company is suffering losses, long-term losses, the owners can do this, the permanent withdrawals, because they have invested. Alright? However, the buying of treasury shares by BBG Corporation, which is again getting back the shares and then giving some money, that is not always possible. Okay? It is because of what do we call as trust fund doctrine. The trust fund doctrine says, since a corporation has no listed names of the owners, because in here you can only see the OSC share premium, the shareholders are actually has limited liability. Okay? So if the shareholders have limited liability, when this happens, like for example, the asset is 10 million, the liabilities is about 20 million. The 20 million of the third party creditors will be taken from here at first, but we still lack 10 million to pay these third party creditors. They cannot go after the shareholders. So the trust fund doctrine emanated from that. Okay? Since there is limited liability for the shareholders, you cannot do this. You cannot let the shareholders get back their investment unless there is a positive retained earnings. For example, in this case, if BBG said, give me your shares, we are BBG, give me your shares, Mr. A, we will pay you 150,000. BBG Corporation cannot do that if it has no sufficient retained earnings. Okay? So, that's the difference. In here, permanent withdrawals are always allowed, normally, in sole proprietorship and partnership. But here, there is a restriction known as the trust fund doctrine in order to protect the interest of the third-party creditors so that this will not happen. You understand? So, that's it. That's the difference. How about accounting? Okay, let's broaden the example first. So the original issuance is 100,000 to us, BBG Corp, we receive 100,000. This is our entry. Later on, at a later date, we got back our shares, 10,000 shares, but we paid 150,000 cash. Next is, for example, 5,000 of those shares that we receive, we call it treasury shares, has been reissued to another party because treasury shares can be reissued. The 10,000 shares that we got back from Mr. A, we can sell it again into other parties. Has been reissued for 90,000, for example. And the 5,000 shares has been retired. Okay? So, that is the complete illustration for the treasury shares. Okay? First, before the reissuance and before the retirement, what will happen? What will be the entry of BBG Corp when we got back our 10,000 shares and we paid Mr. A 150,000 cash? Our entry is simple. Debit treasury shares. Again, let me repeat. We are going to do this if ever we have sufficient retained earnings because of the trust fund doctrine. And the trust fund doctrine prohibits this and actually prohibits also the investors to get back their investment for the protection of the third party creditors. Okay? So, debit treasury shares, you're going to record that at cost. And then credit cash, 150,000. And in order for you to remember, there is a secondary entry, we have first retained earnings. We have to debit the retained earnings, unappropriated, and retained earnings credit appropriated. How much? 150,000. 150,000. Okay? Now let's talk about first here. The retained earnings unappropriated and retained earnings appropriated. The net income of the corporations will go immediately to what do we call as retained earnings. Okay? Retained earnings, again, as I've said in the past video, the net income of the corporation from the very beginning until now will be stored here in the retained earnings. Okay? So, what is this? Retained earnings unappropriated and retained earnings appropriated. Those are subdivisions of retained earnings. So, not all retained earnings are available to be withdrawn by the owners through dividends. Okay? So, those that are only available for dividends is what do we call as retained earnings unappropriated. That means those retained earnings are free for distribution as dividends to shareholders. How about these retained earnings appropriated? The retained earnings, a portion of it could be appropriated or cannot be used. Okay? Retained earnings appropriated, in simple terms, retained earnings that cannot be used. It's restricted because of some causes. It could be restricted for a lot of reasons. Like for example, we could have legal restriction. Under the law, you cannot issue 50% of your retained earnings because under the law, it should be kept. It should be kept in case that there will be substantial losses in the future so that the retained earnings will not be negative. Do you understand? So that's a legal restriction of the retained earnings. And that happens in cooperatives here in our country, Philippines, whereby on the income of the cooperatives, 30% are to be restricted. Restricted for educational purposes, for social development projects, for capital expenditures. So 70% of the retained earnings of the cooperatives here are free for distribution as dividends. As long as the cooperative is already existing for a lot of years already, something like that. So that's an example of legal restriction. Okay, so not all retained earnings are free or unappropriated. Sometimes they are appropriated for by because of legal restrictions. We have also contractual restrictions. Like for example, if the company or the corporation has taken out a loan, and based on the contract with the bank, you cannot use 30% of your net income always or retained earnings. So that's contractual restriction. Or else, even if there is no contractual restriction, there is no legal restriction, sometimes it's based on the judgment of those charged with governance or board of directors, something like that, for expansion, for example. And for things like this, okay? As you can see, we are giving back 150,000 to Mr. A. We're getting back the 10,000 shares. We have to set aside retained earnings and appropriated. And retained earnings is usually positive and is on credit. So we are going to debit it and we put it in retained earnings appropriated 150,000. Okay? So that's the explanation of those two. Although in the next episode, we're going to tackle this as well as the dividends. Okay? In the next episode. Now, so that's your entry upon getting back the cash, getting back the shares and giving back the 150,000. So as you can see, treasury shares are recorded at cost. Okay? Sir, what will happen if ever this happens? 5,000 of the treasury shares has been reissued for 90,000. So meaning, out of the 10,000 shares that are in our hands already, we reissued to another party. Let's say, for example, we reissued it to Z for 90,000. What will happen? On the reissuance, your entry will be debit cash because you have sold it. Effectively, the reissuance of shares is actually reselling the shares at 90,000. And then, we have to credit the treasury shares. Because treasury shares has a debit balance. Actually, if we're going to put the treasury shares account here, treasury shares, that's a deduction on the shareholders' equity. Shareholders' equity or capital account has a credit balance. Treasury shares as well as subscription receivable has a negative effect on the shareholders' equity because their normal balances are debit. Okay? So since you reissued the treasury shares, you have to close the treasury shares, but only for the 5,000 shares. 5,000 shares, since the 10,000 shares, we bought it back at 150,000. That means we bought it at 15 a share. That's 150,000 divided by 10,000, if I'm not mistaken. Let's check. Maybe I'm wrong. So 150,000 divided by 10,000 shares, we have 15. Yeah. So 5,000 times 15 equals 75,000. So we're going to be happy? Yes. Because we bought back the shares at 150,000. So 5,000 is 75,000. And we resold it at 90,000 as if we have a gain. However, we're not going to record gain. We're going to record treasury share premium. How much is that? It's 15,000. Okay? So that's 15,000 treasury share premium, which is another account. Actually, that treasury share premium is one of the family of this OSC share premium or ordinary share capital share premium. And that is to be added. If you see that, you have to add it in the shareholders' equity. Okay? Sir, what if this did not happen? This is reissuance at above cost. Why above cost? Again, the 10,000 shares, we got it back at 150,000 cash or 15 a share. So 5,000 times 15 is only 75,000. That's the cost of the 5,000 shares. We reissued it at 90, which is clearly above cost. Okay? So this is your entry if you reissued the treasury shares that you got back at above cost. There is a credit treasury share premium. Okay? Now, what if we talk about reissuance at below cost? I'm sorry. I'm sorry there are notifications, but it's okay. As long as you understand what I'm saying, just ignore the background noises. So the issuance at below cost, example, it has been reissued at, let's say, 60,000. So what will happen? You are going to have an entry, debit cash, 60,000 only. And then, let's put it on the lower side, cash, 60,000. And the treasury shares at 75,000. So the locking is the debit side, right? So what are we gonna do? Of course, the first that we're going to do, we have to see if ever there is a treasury share premium, because that's the one that we are going to use as a balancing figure. Seeing that there's not, this treasury share premium is for this situation number one. Okay? This situation number two is as if an alternative world of situation number one. So, if situation number one did not happen, we are at situation number 2. So as if there is no treasury share premium. But if there is, that's the ones that you are going to use in order to balance the entry. Okay? But since there's none, what will happen? It's still not balanced. You have to put here the retained earnings already of 15,000. So, that's how it is. Okay? So, again, if the issuance of the treasury shares is at below cost, of course, the debits will be lacking. The first thing that you should do is to find if ever there is a balance on the treasury share premium, because that will be the balancing figure if ever. But if it is not enough to balance the entry, you have to go to retained earnings. Retained earnings, unappropriated. Okay? So, even if the issuance is above cost or below cost, there are secondary entries for this. Aside from this, there is a secondary entry which is the retained earnings appropriated will now be free. You have to take back what was appropriated, which is the treasury shares cost, 75,000, and you need it to be back at retained earnings unappropriated. So meaning, the retained earnings that we're talking about here, both the unappropriated and the retained earnings appropriated are all members of the shareholders' equity, and they are to be added because normally the balance of these retained earnings being the account where the net income of the company is being stored is credit. So this is also credit. Okay? So we have a lot of accounts already that we've talked about. So that's the issuance. So the entry for getting the treasury shares at cost is treasury shares, and then credit cash, it is to be valued at cost. And again, there is a secondary entry, retained earnings unappropriated of what is the cost of the treasury shares will be debited, and it will be put to retained earnings appropriated 150,000 at cost. But later on, if it is reissued above cost, then that means the cash that you will receive from reselling those shares again is bigger than what we have paid to repurchase the shares. It's bigger. We have treasury share premium as credit. And there is this secondary entry, freeing the retained earnings appropriated and storing it back to retained earnings unappropriated. And if it is reissuance at below cost, so that means you receive a cash lower than what you have paid to get back the shares. Okay? So the debit is lacking. So again, you have to find the treasury share premium if there is an account balance there, so that it will become the balancing figure. But if not, if it's not enough, just like this, you go to retained earnings unappropriated. And I guess I'll have to make this video short. So the last one is about the retirement of the treasury shares. What is retirement? It's actually cancellation of the shares. So as if this did not happen. So the 5,000 shares has been reissued. So out of the 10,000, 5,000 was retired as if you have not made those shares in the very first place. That's the purpose of retirement of treasury shares. You're going to cancel it as if it did not happen at all. Okay? As if you are just going to forget that that 5,000 has been issued, and then you bought it back, and then you cancel it. As if you are going to erase all of them. Okay? So what will happen on the retirement? First off, the treasury shares at cost for the 5,000 is again 5,000 times 15 pesos. That's 150,000 cash divided by 10,000. You have to close it, 75,000. And since you're not going to receive any cash in the retirement because that is cancellation, you are going to cancel the ordinary share capital account. Because if you remembered, when you first sold those shares to A, this is your entry. We have OSC 10,000 times 5 and OSC share premium 50,000. So the 5,000 of this one, this is 10,000, right? And we're talking about only retirement of 5,000 shares. So we're gonna consider 5,000 times par value of 50. That's 25,000. So as if we are erasing that this happened. The original entry as if did not happen. Okay? So that's the focus of retirement. So if this is credit, we have debited the ordinary share capital at par for the 5,000 shares. So the problem is it balanced? Of course, it's not. Right? So the first thing that you should do is look for the original ordinary share capital share premium original issuance. So this is the original issuance. The original issuance pertain to the first issuance of those shares to Mr. A. Okay? So this is the ordinary share capital share premium original issuance. This one. Okay? You have to debit that in order to balance the entry. However, the ordinary share capital share premium original issuance of 50,000 is not the ones that you are going to debit here. It's only 25,000 because the original issuance ordinary share capital share premium for 5,000 shares is only 25,000, right? This 50 is for the 10,000. So you have no right to cancel all of it, the 50,000. Only the 25,000 because 5,000 is the only ones retired. Okay? Is it balanced already? Not yet, right? So you find again the treasury share premium. And since this is our original problem, this is just an alternative, the reissuance at below cost. As you can see, there is a treasury share premium. You have to use that here, 15,000. So 25 plus 25 is 50 plus 15, 50 plus 15, 65. So there is still a lacking on the debit. The lacking on the debit is actually retained earnings unappropriated again. So how much is that? 10,000. I'm sorry. That's 10,000, okay? So the entry is already balanced, and of course, you have to remember that you have to free the retained earnings appropriated by debiting it with 75,000 and then putting it back on retained earnings unappropriated 75,000. Because there is no need to keep retained earnings because the treasury shares has already been cancelled or retired. So, because of that particular entry, it's as if this one and this one has been cancelled for 5,000 shares only. And treasury share premium has been, what do we call this? Has been caught because of cancelling of the 5,000 treasury shares as well as the retained earnings unappropriated. Okay? Sir, what if upon the retirement, this is not the case? In this case, the debits are lacking. What if the credits are lacking? What particular account are we going to use? The same here. So if ever the ordinary share capital is at 50 and the treasury shares is at 40,000, for example, 25,000 here, right? For example, if the treasury shares is purchased at a cost of 20, so 25.20, the credit is lacking, right? You have to use the treasury share premium account. The same with this one. So if the credits are lacking, treasury share premium. Okay? So if you're going to summarize, if we're talking about reissuance at above cost, so that means there is a treasury share premium that should be credited. But if it is a reissuance at below cost, the debits are lacking. So you have to look for the treasury share premium if there is, and then if there's none, or if the treasury share premium is not enough to balance the equation, the entry, then you have to have a debit under retained earnings and appropriated. On the retirement, if the debits are lacking, then that means first you have to find the original issuance ordinary share capital share premium. And if it is not enough, you find the treasury share premium if there is. And if it is not enough to balance the entry, you have to go for the retained earnings and appropriated. So that is the accounting for treasury shares. Last, so if ever you sold the 10,000 shares to Mr. A, and then there is a dividend declaration or the giving of cash dividends. Cash dividends, like for example, we're going to give dividends to shareholders, 2 pesos per share. So that means A, if he is the shareholder still, we have not bought back the shares, so Mr. A will receive 10,000 times 2 pesos dividends, that's 20,000. So dividends are in the form of value per share that you own. Okay? Sir, how about treasury shares? If the board of directors declare to give 2 pesos per share and that Mr. A has already returned the shares to us as the company, we will we be given also dividends? Of course not, because treasury shares are our shares that we have originally issued, but we have taken them back. It is illogical if we pay ourselves dividends also. Okay? So treasury shares will not receive any dividends because treasury shares are issued shares. That means there is a share certificate there, but it's not outstanding. Outstanding meaning, if we say outstanding, it's in the hands of the shareholders. It's not. Treasury shares are not outstanding. It's in our hands. Okay? So is that very important? Yes, it's very important because when paying for 2 pesos per share dividends, it will be deducted in the retained earnings unappropriated. So you will not be correct if ever you pay for treasury shares, dividends to treasury shares. Again, treasury shares does not deserve to receive dividends. Okay? You will be wrong in the problems if you have given dividends to treasury shares. Okay? So that's it for this video. This is for accounting of treasury shares, both reissuance at above cost, at below cost, as well as retirement of treasury shares. So thank you for watching and see you on the next one for the other things that you need to know.